Where are you with this inflation debate? I mean, what will it look like in the months to come, for instance?
Well, if we look at yesterday's inflation print, both headline and core inflations are well above expectations. And if we look at the underlying details, it's basically just suggesting that increasing portion of the rises in price actually are more persistent rather than transitory. If you look at services, the services prices, what we see from last month is the pickup in terms of rents, particularly rents and medical care. Those categories are the more persistent categories. So we can actually have higher confidence to say that inflation is more likely to be persistently high rather than coming down.
But, I mean, you look at, for instance, the other side of the equation. For inflation to be consistently high, you need to have some kind of demand pull inflation as well. Now, if you look at real wages in the US, they are actually negative. Now, surely that's going to be a constraint on your hypothesis.
Well, that's a good point. We need to look at, there is always a short-term versus mid-term and longer-term perspectives for inflation. Over the longer run, we still have, as you said, probably the demand side of the equation. And also we have the technology, which is always more deflationary. And of course, we need to be worried about probably China growth slowdown as well.
Jenny, it does seem like the market fully pricing in a rate hike by the middle of next year. The thing is, even if the Fed moves tomorrow, it will be behind the curve.
Well, now the key question here is whether this inflation print is going to translate into higher inflation expectations. If we look at inflation expectations, so far it's still within a historical reasonable range. But if that goes above that, then we think that will push Fed to hike.
What do you do? How do you invest? What do you go into and stay away from in this environment?
We are still short duration, so for our portfolios, we would like to underweight U.S. duration at the moment, and we're trying to find where that the assets have less correlation with duration. For example, Asian credit.
In China, Jenny, when you take a look at the bond market, I mean, the foreign investors have fled pretty much in the last month or so. Is there anything to pick up? Are you still concerned about the property space and the contagion effect?
There are a lot of reasons for us to be concerned, but also at the same time, there are opportunities here. And we've seen that over the past month or so. We see more and more slightly positive signals from the government trying to at least bottom out the tightening measures in the property space. And we have seen some good behaviors from property developers. For example, Evergrande continues to cure its a coupon payment, and we've seen some other developers actually pay down their debt.
The thing, Jenny, is can they keep paying down these coupon payments and the actual principals looking at, I mean, they've got $2 billion due in March or around that number here?
Or we can ask the question as why they're paying it now, given that they still have so much else to pay. I think that does buy them time.
It's not exactly an environment where they can raise money either.
Exactly. But it does buy them time to avoid official default that could actually roll into a much bigger and messy process.
But again, you know, it's going to Hazard's point. We've seen foreign money flee because there is a feeling that, you know, the bottom of the pile are these dollar bonds, offshore bonds, and that they are the ones which are likely to be compensated last?
Well, not necessarily. Historically, actually, the offshore recovery has been actually higher than the onshore. And yes, we are subordinated to onshore investors, but the offshore market actually serves a very different purposes for a lot of those issuers. When they can't issue onshore, offshore is the only place they can come to.
Okay, but what about the reverberations of this? We haven't seen this, but longer term, the whole property market in China has to evolve. It has to meet the demographic challenges that it faces as well. That has implications for debt-laden local governments who rely on land sales, for instance. Now, a property tax is not going to deal with that because you're going to have fewer transactions as well. So give us a sense of how this does actually have an end game.
Absolutely. I mean, this is the structural problem that China has. And we see that the government actually has the intention to grow out of this high debt-driven growth model. And the property is the core of it. right? So how can they do that? Now they're trying to, in the Chinese way, they said exchange space with time, or exchange time with space. So they try to buy time. So we all know what's the end game, where they want to achieve the goal. But now the key is the path towards it. Right? You don't want to do it too aggressively that all of a sudden you have this trigger systemic risk. Well, at the same time, you don't want to encourage moral hazard at the same time.
Jenny, what about the ripple effects? In its stability report, the Fed warned that if it gets worse, it could spread to the U.S. And also, what are the ripple effects for the rest of Asia?
So far, the knock-on effect actually has been quite limited. I mean, the sell-off in the dollar market is mainly in China property, and from the weaker property to even the stronger property, but it stops there, almost stops there. So now if we see that at least the policy is bottoming out, we could see that at least it's not going to translate into a spillover into other parts of the Asia, let alone other parts of the credit markets in the world.